Welcome to the global edition of our Net Group Investments Quarterly Highlights, where we profile some of the interesting takeouts from our recent fund manager workshop with our global best-of-breed managers. To hear the full fund manager presentations or for more information about our funds, visit the Net Group Investments website or access more of our content via LinkedIn, YouTube, and podcast channels. This episode begins with the Q1 overview of the bond market. We examine the global outlook for interest rates in 2024. We interview a veteran global bond manager who explains how he has achieved superior performance with his multi-asset fixed income portfolio. We find out the reasons why a global equity manager has a positive outlook on a global insurance broker. We end this episode with a discussion on key real estate themes for 2024. David Roberts, who co-manages the Net Group Investments Strategic Bond Fund, shares his main insights from the bond markets in the first quarter of 2024 and how his portfolio was positioned.
So, just thinking about the market then, we thought we'd start with a quick snapshot of what's happened in bond land over the course of the first quarter. Generally, economic data was significantly better than most people had forecast, and that meant that the expectation for central bank action was pushed back significantly. Across the G7, as many as 7 interest rate cuts had been penciled in from, amongst others, the Federal Reserve. That reduction in expectation for rate cuts in 2024 meant a small rise in sovereign yields. And by the end of the quarter, the market was forecasting round about the same number of cuts as central banks had anticipated. The gap had narrowed but not completely closed. Risk assets from equity to corporate bonds continued to surge, generally led by anything AI related. If we think about performance, then over the course of the quarter, central banks' expectations were rolled back, but as I said, yields actually didn't move that much. For those who have looked at Alex and I's comments over the course of the past year or so, prior to launch and after launch of the portfolio, you'll see that we talked about the old normal, which really means that we expect interest rates to be much more sticky, to move much less than many in the market had expected. Now, most investors, I would say ourselves included, do believe that we will see some rate cuts in 2024, just not as many as the market had been expecting. So this slight change of expectation did create a little bit of volatility, rates moving up, rates moving down, credit spreads moving tighter and slightly wider, and that gave us an opportunity to add a little bit of value, as we'll see shortly. Corporate debt, as I say, really over the quarter remained largely unfazed, supported as we saw money moving into all forms of risk assets. Relative to the underlying index, we remained overweight, but our quality bias is significant. And in addition to that, we have a shorter maturity profile in the corporate bond sector. And as we'll see, what that does in combination is give us a nice level of income relative to the market, but also gives us a degree of volatility protection.
Daniel McDowell, CIO at Perfect International, shed some light as to why the market is currently pricing in less interest rate cuts in the US than it did at the start of the year.
During the quarter, expectations for rate cuts were considerably delayed. There are fewer Fed rate cuts now expected in 2024 than at the beginning of the year. And that means rates are forecast to stay higher for longer. The market moved from 6 to 3 predicted rate cuts in 2024 over the course of the last 3 months, so quite a dramatic move in those terms. Why is that? Well, it looks like inflation might be stickier than we originally thought. It makes sense to us when you consider the long-term effects of things like demographics, namely China is no longer the expanding cheap workforce that it has been for most of the first 2 decades of this century. You can look to deglobalization. There's a suspicion between major powers that has meant that supply chains, they're increasingly being reconfigured to prioritize security of supply rather than cost optimization. And we've seen that particularly in the semiconductor chip industry with recent investment decisions in the US and Europe. And decarbonization, that energy transition is not going to be cheap to enact. And all of these factors point to higher inflation than we've been used to in the pre-COVID years. And that means higher rates, and the higher rates present risks for equity market evaluations.
David Roberts describes how his global strategic bond fund outperformed its benchmark by 40 basis points in Q1.
If we look at some of those drivers of performance, then they've actually been quite widespread. Most people tend to think about fixed income as having very few levers to pull. But one of the good things about a truly global strategic fund is that there are many sources, both of, I would say, beta, so market direction, and then also alpha, so what additional performance can we add without worrying too much about market direction. And I guess most people would think that it's really all about duration management, so how much interest rate risk you take. But of the 40-odd basis points that we returned through the quarter, really only 5 or 6 of those came from pure interest rate management. As I say, over the quarter, yields were actually little changed. And some of that small amount of gain actually represents what I would call almost short-term trading. So taking advantage of this volatility within the market rather than changing our strategic stance. We also did quite nicely from the move in the interest rate curve, which during the quarter started off flattening, so long-dated bonds performing better than short-dated ones, and then reversing that as we moved through the quarter. Geography, though, and asset allocation were quite important. As I mentioned earlier, we were ahead. We had a higher weighting to credit than the index, but also our geographic spread was very nice. So we continue today to have a similar geographic exposure, which favours Europe versus the US and Japan, 3 of the major components of the core part of the bond market that we look at. With Japan abandoning yield curve control, again, that added to our portfolio, and we were a heavily underweight index, and indeed in absolute terms had a small short in Japanese bonds. But lastly, one of the major contributors to performance was credit selection. And Alex and Matt, who work with me on the portfolio, did very well to avoid any of the credit disasters through the course of the quarter. Many people may not be familiar with names like Altice and Thames Water, but Altice is one of the biggest European telecoms companies. It's just a conglomerate, junk bond rated, and one that really we've had some concerns about for years. And that did drive down index and also some performance too. But at the same time, we gained from some of the higher beta names in the portfolio.
Stephen Romick, core portfolio manager of Net Group Investments' Contrarian Value Equity Fund, shares what contrarian value investing means to him and his core portfolio managers.
Brian, Selma, Mark Landecker, and I, as portfolio managers of this fund, are like-minded, but obviously, as the question points out, different people. But the one thing we have in common is we like to buy what others are selling and sell when others are buying. We like to, arbitrage fear and greed in the market, take advantage of the opportunities presented. So we are always more excited when shopping in stores where they're offering merchandise at a discount. And that's, what we have in common. That's what contrarian means to us, is buying what others don't want to own. And similarly, selling at a point in time when everybody else is really excited, taking advantage of the so-called animal spirits.
Daniel McDowell shed some light on significant developments in Japan.
If we turn to Japan, aside from the record level of the Japanese Nikkei 225, the other notable development in Japan was that in the first quarter, the Bank of Japan raised their target interest rate for the first time in nearly 18 years. And that took rates into positive territory for the first time since 2016. And one of the key drivers of that has been the emergence of positive wage inflation in Japan. And that's what's shown here on slide 6, with bargaining agreements seeing 5% rises in the most recent round. And those are levels that are unheard of over the last 30 years. And at face value, that's a victory for Japan because it looks like it marks the end of the threat of deflation that hung over the economy for so long. But with this apparent victory comes risks. When you have a country that has a stock of public debt as big as Japan's is, which is the largest relative to GDP in the developed world, the cost of servicing that debt can quickly become troublesome, even if rates experience a modest rise. So a material increase in rates may well expose some of the structural flaws and consequently upset market sentiment.
Nate Group Investments Global Equity Fund bought Aon shares in Q1. Portfolio manager Mike Moore explains why they are bullish on this company.
In terms of the new purchases, I'll speak to Reach on shortly, but Aon is an insurance broker. It has very strong return on invested capital. It has durable cash flows that it has grown consistently over a period of time. So it's a very stable growing business. So its top line has grown sort of 5 to 6% over the last 5 years. Over the last decade, it's increased its margins by 11 percentage points. And what we found with Aon is that they were undertaking a deal for a company called NFP in the mid-market of the insurance brokerage industry. And the market perceived that they were paying a full price. And so that obviously had an impact on the share price and sentiment. And we use that as an opportunity. We do actually think there are going to be material synergies with that business. Whilst the core business, we believe they will still be able to accrete margins further still. At the same time, they've got a very good capital allocation strategy whereby they return 2 to 3% of shares, reducing per annum. And so what you get is a free cash flow per share growth for this business that we think is in the teens. And we were able to deploy capital into that with the PE of sort of sub 20 times. And so it's a very durable business, has high return on invested capital, strong market positions, and we think that actually that is that is a very good risk reward for us going forward.
We explore the global real estate markets with Robert Promersal. He also shares how his portfolio is currently positioned.
And then thematically, our portfolio is structured in the sectors that really matter for the economy. For retail, it's about necessity shopping centers. So the regional malls I mentioned before all have grocery anchors to them, both Center Group in Australia and Unibail-Rodamco in Europe. And then in the U.S., we have exposure to strip shopping center companies, which are necessarily grocery and drug anchored. So that drives necessity shop and frequency. On the residential side, our portfolio is exposed to rental housing. In the U.S., coming out of the GFC over 10 years ago, there just hasn't been enough new supply of housing that's been created. As a result, demand exceeds supply. And we're seeing some of the rental housing companies that were born out of the GFC have very strong lease fundamentals. Invitation Homes is one of the larger positions in the portfolio. It's the largest listed single-family rental housing company in the U.S. And we expect its NOI growth to be in the 4 to 6% range for the next several years. We've talked a bit about data centers already. It's an important part of the market, important part of the economy, particularly as more and more activity happens in digital formats. And data centers really where that digitalization is physically housed and transmitted. Logistics is an important part of the portfolio because of the increased drive towards efficiency, the onshoring that's happening. There's more and more inventories and production are being moved from Asia-Pac, really from China, into a major market like the U.S. and Mexico. In fact, I'd point out that the portfolio initiated a position in Fibra Prologis in the first quarter, which is about a $5 billion US dollar equivalent industrial portfolio in Mexico. And then healthcare, talked a bit about seniors housing, both in this call and in previous ones, remains an important part of the portfolio because we're just on the front end of what we call the gray wave, where you have the over 80 population in the U.S., which are the primary renters for seniors housing. Their growth is expected to increase by 3x over the next 10 years as you have the baby boomers age into prime rental years.
You can access more information about all the fund manager workshops at Nate Group Investments website, YouTube, or through our podcast channels on all major platforms. This has been your Nate Group Investments quarterly briefing. Make sure to check back at the end of July for our next edition.